Did you know that thousands of traders lose money in gold every single day, not because gold is difficult, but because they trade without understanding how the market works? In today's video, I'll show you the fundamentals of gold trading in a simple, beginner-friendly way. By the end of this video, you'll understand what moves the gold market, how to read a chart, how to identify trading opportunities, and how to manage your risk like a professional. So if you're serious about learning gold trading, stay with me until the end. Welcome back to the channel. If you're new here, this video is designed specifically for beginners. We'll avoid complicated jargon and focus on practical concepts that every new trader should understand before placing a trade. Whether you're trading on MT4, MT5, TradingView, or another platform, these principles apply everywhere. Let's begin. Chapter 1. What is gold trading? Gold trading means buying or selling gold based on expectations of future price movements. Unlike investing in physical gold, traders don't usually own the metal itself. Instead, they speculate on whether the price will move up or down. The most common symbol you'll see is XAU/USD. Here, XAU represents 1 ounce of gold. USD represents the US dollar. If XAU/USD rises, gold becomes more expensive. If it falls, gold becomes cheaper. Gold is one of the most actively traded assets in the financial markets because it offers excellent volatility and liquidity. Chapter 2. Why gold price moves. Gold prices move because buyers and sellers constantly react to economic events. Some of the biggest factors include the strength of the US dollar, interest rate decisions, inflation, central bank policies, geopolitical tensions, employment data. When uncertainty increases, many investors buy gold as a safe haven asset. That's why gold often rises during economic crises or global uncertainty. Learning these fundamentals helps you understand why the market moves instead of simply guessing. Chapter 3. Reading a gold chart. Let's learn how to read a chart. Each candle represents price movement during a specific period. The body shows where price opened and closed. The wicks show the highest and lowest prices reached during that time. Green candles generally indicate buyers were stronger. Red candles indicate sellers had more control. Never focus on a single candle. Instead, look for patterns, trends, and important price levels. Ask yourself, is the market making higher highs and higher lows, or is it making lower highs and lower lows? This simple observation helps identify the trend. Chapter 4. A simple beginner strategy. Let's build a straightforward trading strategy. Step 1. Identify the overall trend. Never trade against a strong trend without a solid reason. Step 2. Mark important support and resistance levels. These are areas where price has reacted multiple times. Step 3. Wait for price to revisit one of these levels. Step 4. Look for confirmation, such as a rejection candle or a strong breakout followed by a retest. Step 5. Enter your trade with a predefined stop loss. Step 6. Set a realistic take profit based on the next key level. Remember, patience is often more profitable than frequent trading. Chapter 5. Risk management. This is the section that separates successful traders from everyone else. Never risk a large portion of your account on a single trade. Many experienced traders risk only 1 to 2% of their account per trade. Always use a stop loss. Never move your stop loss farther away because you hope the market will reverse. Maintain a favorable risk-to-reward ratio, such as risking 1 unit to potentially gain 2 or 3 units. Over time, consistent risk management matters more than finding the perfect trade. Chapter 6. Common beginner. Mistakes. Here are some common mistakes to avoid: trading without a plan, using excessive leverage, ignoring stop-loss orders, overtrading after a loss, chasing the market after a big move, trying to recover losses quickly, following random signals without understanding them. Professional traders focus on consistency rather than excitement. Let's quickly recap what we've covered today. Gold trading is based on understanding market structure, trends, support and resistance, and proper risk management. Don't rush into live trading. Practice first using a demo account. Build confidence before risking real money. Remember, successful trading is a marathon, not a sprint. If you found this tutorial helpful, give the video a thumbs up, subscribe to the channel, and turn on notifications so you never miss future trading lessons. Leave a comment below telling me what topic you'd like to learn next. Price action, candlestick patterns, support and resistance, or advanced gold trading strategies. Thanks for watching, and I'll see you in the next video.